do the latest numbers all mean for you and the overall economy as we look ahead to next week's rate announcement? Jean-François Perrault is the chief economist at Scotiabank, and Stéphane Marion is the chief economist at National Bank of Canada. Hello to both of you. Thank you very much for making the time for this. Mr. Perrault, I'll start with you and get your read, if you don't mind, this morning on essentially the growth numbers, in particular for the third quarter. What do you take from those numbers?
Well, listen, I mean, obviously the decline, right? So that's not a great thing in and of itself. But when you look at some of the details, I mean, we know that they were still impacted by things like the port strike in Vancouver, some kind of wildfire activity. So some special factors that kind of distorted the numbers, which, make them a little bit less negative in our view than perhaps the headline would suggest. And then you've got on top of that some indications for October GDP coming out of Stats Canada as well, which, kind of a rough look ahead of what that might be. And it's a pretty substantial growth that they're tracking for the month of October.
So what do we take from that kind of in layman's terms, Mr. Marion? Because I think a number of Canadians are looking to those indicators to find out, hey, are we going to be in a recession at some point next year? How slow are things going to get? Is my job in peril? What do you read into the situation as it exists right now? And what do you look ahead to as far as growth in the economy in the future?
Right now, what we're showing, and JF is right, there's volatility in the number, but I think we'll both agree that we're stagnating right now. And what's the outlook for the next few quarters? Well, the outlook, Vassy, is the fact that we haven't seen the full impact of monetary policy yet, just because of the normal transmission lags of monetary policy. So even if the Bank of Canada doesn't hike interest rates in the months ahead, we're going to see the impact of previous rate hikes. And what was quite telling in the third quarter was the fact that the consumption was quite weak. So despite the fact that we had a population burst, a record increase in the population of the third quarter. So we should have expected to see better growth numbers on the consumer. So I understand what JF says, the volatility in numbers, but we're looking at stagnation for the months ahead.
With the consumption flatlining, Mr. Perrault, do you take from that the interest rate hikes are beginning to take effect in a material way, or will they take further effect, and will we see sort of further indicators of that to come?
Well, both, to be honest. I mean, it's very clear now that interest rates are having an impact. We've seen the impact on the housing market for quite a while. And that, takes some time to feed through consumption as kind of folks pull back on, furniture and appliances and those kinds of things. But we are now seeing that brought into kind of more discretionary type of expenses. So we know that consumption is being impacted by interest rates. And as Stéphane just indicated, we know also that interest rates operate on the economy with a lag. Yeah, so we've only seen a fraction of the rate impact so far on the economy. And as that goes forward, as those rates kind of feed through the system and more completely, well, we would expect consumption to reflect that to some degree.
As far as what that stagnation means in real terms for Canadians who are watching right now, Mr. Marion, who are again seeing minor upticks to the unemployment rate, which is different than we've seen in previous months. The job market is still very tight, but it's going in a different direction, I guess, than we're used to. How worried should they be about job losses or a potential recession? We keep hearing the words technical or moderate or soft landing. How would you interpret that in real terms?
I think it would all depend on how quickly inflation comes down and how that will enable the Bank of Canada to cut rates. So I think I am expecting rate cuts in 2024, and that depends on inflation. And the good news is that inflation is coming down quite significantly in the past few months. So with lower growth, that means less inflation. So we're on the right track. So I'm expecting, a recession in 2024, might be a slight recession. The magnitude will depend on how fast inflation comes down and how quickly the Bank of Canada can cut rates. But I think we are looking for rate cuts, and that will bring some relief to consumers in 2024.
I want to quickly follow up with you, Mr. Marion, on the potential for rate cuts, and more specifically what you anticipate next week. Do you think the bank will hold the line based on the data that you've seen so far?
I think they have to hold the line, and they have to recognize that the increase on the unemployment rate that you spoke to is a sign that the interest rates are starting to bite harder, and they might, think about revising down their forecast for next year. We'll see. It's not at the next meeting that they'll announce that, but clearly, my view is that they need to stay put and to say maybe a more cautionary note about the performance of the Canadian economy.
Mr. Preau, last question to you, and it's actually about some analysis Scotiabank did that informed a lot of political debate around the fall economic statement, and that is the degree to which government spending, both at the provincial and the federal level, has contributed to interest rate hikes. Can you break down as simply as possible, for all the political noise our viewers are used to, how much has the fiscal side of things, combined both provincially and federally, added to the issues that we're facing with interest rates?
Well, listen, I mean, it's very substantial. So if you go back to, say, pre-pandemic government spending levels, and you assume the governments kind of stayed on track with what they were doing then at the provincial and the federal and municipal levels, instead of the very significant increase in government spending in relation to GDP that we've observed since then, you get that the Bank of Canada was probably, raised rates about a couple hundred basis points more than otherwise would have been the case, if you include on top of that some of the pandemic transfers. So out of the 475 basis points of tightening that we've seen, maybe a couple hundred basis points, maybe 2 percentage points of that is because governments have effectively made the Bank of Canada's job much harder by increasing expenditures a lot. And of course, there are good reasons to increase expenditures in some cases, in other cases less so. But I think the interesting thing in our report was, there's this tendency out there to say this is all the federal government's fault. Whereas when you look at government spending, government spending at the provincial level is 3 times higher than what it is at the federal level. So what matters, what happens there has had a big influence on the Bank of Canada.
All right, I'm going to leave it on that note. I appreciate both of you making the time for this conversation and for your analysis as well. Thanks to Jean-François Perrault with Scotiabank and Stéphane Marion with the National Bank of Canada. And still to